Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And today we're going over GE Vernova, which is a spinoff of GE, and it's only been around less than 2 years, but it's been up 275% over these past couple of years. GE Vernova. And folks, remember, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's see what this company does, because so many of you have not heard of it. But on the other hand, we've gotten a lot of questions about this stock and what we think about it here at Buffett and Beyond. Well, let's go over a few things so that we catch everybody up. Now, GE Vernova was spun off from GE in April of 2024. So, folks, that's just last year. Now, the company provides products and services that generate, transfer, orchestrate, convert, and store electricity with the aim of reducing carbon emissions. So that's pretty important. Management claims that approximately 25% of the world's Management claims that approximately 25% of the world's electricity is generated using GE Vernova's technology and equipment. That's because this company is new, but GE has been around for 150 years or so, folks. Now, this company, this spinoff of GE, has 3 business segments, and it includes gas, nuclear, and hydro, and then it has wind and electrification. And these are grid solutions, power conversion, and electrification software. And let's go over those a little bit. But revenue by segment: power 51%, wind 27%, electrification 22%. So, folks, it has about 75,000 employees, which means that it's not a small company by anybody's imagination. Now, here's something that we just found out this morning. GE Vernova has installed 240 gas turbines in China at $50 million each. Okay, so they're not little toys that you're going to get your kids for Christmas. Now, new data centers are being constructed for AI, which will require a substantial amount of power, and that's where these gas turbines come in, folks. But let's go back to the wind for a second. The wind has decreased in demand because there's a lot of people out there that do not want these offshore windmills or the wind generating plants out there offshore and even onshore. So they're getting a lot of pushback on those areas. So the wind area has decreased by about 38%. However, electrification, which makes equipment for electrical grids, and upgrading these assets has become a priority for most utilities as the nation is bracing for robust growth and demand. And I just read that from a report on this company. So the orders recently rose 19% to $15.7 billion. So the electrification part of the company is more than making up for the decrease in the wind part of this company. But there's a lot of data centers that are not near big, powerful electrical generation areas. So there's a lot of countries that need wind. There's a lot of countries that need, gas turbines, and that's what's going to power a lot of these AI centers all around the world. These gas turbines are the key. And GE turbines and gas turbines were around since I was an engineer at one time. So yes, I'm familiar with this area of the power generation that is needed in the new AI data centers, folks. So let's look at this company, and we have very, very little data on it because this company just started last year. Now, why is this owner's equity? And remember, owner's equity in clean surplus accounting is totally different than the traditional accounting owner's equity. That's what makes clean surplus totally different than traditional accounting. So when a company is this young, we have to make an educated guess on what this book value really is, because it has not been cleaned up. And don't forget, GE Vernova has been around for a long time. Not the company, not GE Vernova, but GE. You don't think this company just hired 75,000 employees. No, it's been part of GE for a long time. So the owner's equity, that when it's spun off, could be a very arbitrated number. And so we have to do a lot of research to come up with a number like this. Now, how do we know we've come up with a fairly decent number? Because, number one, the net income has been rising, and we're going to come back to that. But the clean surplus ROE, which is our main number that we use in our stock selection methods, and don't forget, we're outperforming the S&P 500 2.5 to 1 on a compounded rate over the past 22 years. So we pretty much know what we're doing with the clean surplus ROE. Back to what I was talking about. How do we know that we have a good owner's equity here? Because it's this net income here divided by this number here that gives us clean surplus return on equity. But when we come up with a number over here and then we see this number, clean surplus ROE, rising, then we know we made a very, very good estimate. And I tell you what, for the first time that we had to come up with a number here, this is the strongest I've seen it rise from the base amount of 19%, because now we're up to 25.4% predicted for next year, 2026. So when we look at the net income growth rate, we are looking at 20% from last year to this year, and then a 53% growth projected for next year over this year. So that is very, very encouraging. Now, the revenue growth here is just 7.7% for next year, and the average stock is 7.1%. Now, net income growth over here is the average is about 13% for the average stock, so the net income growth is just phenomenal. The revenue growth, however, just has us just a little bit worried, but we can see it's going up from 4.8% for this year over last year, and now revenue growth of 7.7%. So it's rising. It's definitely going in the right direction. Now, years to pay debt. Folks, this company has no debt. Can you believe it? A company like this that's in power generation with no debt is very, very rare. In fact, I think this is the first one I've ever seen. And I've been in the power generation industry for a long time, because that's what I did as an engineer. And power generation always is capital intensive. And here's a company that has no debt. It's working internally. And folks, it's retaining 90% of what it makes that it's putting back into itself in order to grow. So this company, from all the numbers, and we don't have a lot of numbers, but boy, it looks very, very good. Now let's look over the 2 years, and here's the line right in here. Right in here. This is when it started. Black line is the S&P 500, and we can see GE Vernova just started out with the S&P 500 for about 4 months, and then all of a sudden has been growing ever since. And then when it had a pullback just recently, boy, oh boy, it made a double bottom in here and then took off like a rocket, which leads us to believe, and now here's another chart, and this is the about 2 years of GE Vernova. Now, this red line is the 200-day moving average. And why does it start right here? Because it needs 200 days of price data in order to start the 200-day moving average. So you can see right from here, previous to this company was only publicly traded for 200 days between here, and this looks like another 200 days or so. But that double bottom that I mentioned in there came to test this 200-day moving average, and boy, when it tested and it went up 3 days in a row, it just continued to shoot up. Thing is that this indicator up here, it's a technical indicator called stochastics, is saying that the company is over, or the price is overbought. And this indicator down here is saying the stock is overbought. So before you run out and buy it tomorrow, this is one of those stocks, and I very seldom say this because either I'm in a stock or I'm out of a stock, but this might be one of those stocks that you just take it easy in the beginning, wait for this little correction that sure looks like it's going to come. And you see these green lines in here? Well, this is volume when this particular stock closes up for the day, and the buying volume has declined right in here. But then again, the red volume is the volume when the stock closes down for the day, and that's very, very light. So we're a little perplexed here. So this is one of those stocks, one of those rare stocks that I would say maybe you just start going in a little bit at a time. But this company might be a very, very good company going into the future, especially with those gas turbines and all the data centers that have to be built. And they take a lot of energy. You're hearing this all the time on TV, on the radio, and reading about it in analyst reports about how much power these data centers need. And boy, when you're out there in the middle of the desert and you have no utility lines to hook up to, then you need those gas turbines that GE Vernova sold to China for $50 million each. So, folks, that's what we're looking at. And GE has been making turbines since forever, over 100 years, folks. So they know how to do it. So, folks, we had a good week this week. I hope I answered some questions on GE Vernova, because there are a lot of questions on it, and a lot of you haven't heard about it, and those of you who have questions on them. So we're looking at a stock that's increasing each year, and it's only been around a couple of years now, but it's increasing its income, its profitability, and we're going to see or hear a lot from GE Vernova going into the future, because it thinks about the emissions that we're all worried about on this planet. So, folks, yeah, go in, buy a little bit at a time and see what happens. But meanwhile, it's the weekend. Take your mind off the market. You have a safe weekend. Be with your family. Be with your loved ones. And, folks, we'll see you right back here in a couple of days. And remember, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now.